We have Phelan Spence, who's going to talk about financial forecasting. Phelan comes to us from JumpStart, where he's the deal flow and senior accounting associate. And as I mentioned today, we'll be talking about financial forecasting. If you have any questions, please post them in the chat, and we'll make sure to keep an eye on those and get to them throughout the session when it makes sense. If not, we'll get to them at the very end. So without further ado, Phelan, take it from here.
Thanks, Doug. And actually, my title has changed slightly since we last did this. So I'm now officially Services and Financial Analysis Associate. So lots of business jargon there, but basically, I work with startups and small businesses around the city of Cleveland and sometimes across the state of Ohio, mostly in Northeast Ohio. To help them with things involving mostly their finance and accounting, but I also do touch on other subjects like marketing, especially because that has such a big impact in financial forecasting. Just a little bit of background on me so you know where I'm coming from. I have been with JumpStart for about 4.5 years now. I started kind of straight out of college after studying international business and Spanish. I started at JumpStart on their internal finance and accounting team, and then have kind of just gradually made my way over to be more client facing and helping our clients with their finance and accounting. And it seems like a lot of clients have a need for help with their financial forecasting. So that does seem to be a pretty popular subject. So that's what I'm here to talk to you today about. This is a pretty exciting topic. I think we all have our different ideas about financial forecasting, and I'll try to tie a lot of these ideas together and make them work for us to actually produce something that helps us out as we think about like how we're building and planning our businesses. So with that being said, let's get into it. One quick note before we get into like the content and the agenda here. Doug said financial forecasting. I have said financial projections. You may hear financial modeling. You may hear budgeting. I've even heard like creating a profit plan. These are all very similar terms for basically looking into the future and estimating, how our finances are going to look a year, 2 years, 3, 5 years from now, however long it may be. So some of these terms have slightly different flavors, but they mostly mean the same thing. I may use them interchangeably. Others may use them interchangeably. Some people may not. Some people may say that these actually do mean different things. But for the purposes of this presentation, I'm going to use them as if they all kind of mean the same thing. We're financially mapping out your business's future. All right. So let's get into the agenda here. I want to start off with a little bit of perspective about kind of how you should approach financial projections, because I think that's pretty important. And then we'll get into the explaining just an overview of the main financial concepts that make up the base of pretty much all financial projections. And then if we have time, we're going to go through a quick financial model walkthrough. I'll just switch over to an Excel spreadsheet, and then we'll walk through that. And then at the end, I want to make sure to put some action steps in front of you, as well as some more resources on this subject and other subjects. All right, so let's get into a little bit of the perspective that you should hopefully have when approaching financial projections. So financial projections should empower you to answer these difficult questions. first and foremost, when and how will this venture be profitable, right? And then going along with that, number two, what do my team and I need to do on maybe a monthly or quarterly or even weekly basis to make sure that we are driving towards profitability? And then, of course, as you are estimating your revenues and expenses, and you're seeing any cash shortfalls that you might have, you're going to be asking yourself, like, when and how much financing will I need? And then additionally, as you get into the weeds of calculating, your sales and your different marketing strategies, you're going to develop a list of vital signs for your business, so that you can track those on like a weekly or monthly or quarterly basis to make sure that you are hitting the goals that you need to hit. And if things aren't going the way that you want them to, you can pivot somehow and kind of realign your efforts. And then fifth, how do I make my goals more realistic and accurate? I think, general questions I hear about financial projections are, like, how much money should I make next year, right? Like, and I think financial projections are one way to work towards that number instead of drawing that number out of the air. How many sales should I have, right? Like, if you do financial projections correctly, and we'll go through the process, you should have a fairly reasonable and realistic idea of what your sales should be next year or what your profit should be next year. The same goes for like gross profit. People often ask, what is a good gross profit margin for my business? And the answer is really that it depends. It depends on your industry. It depends on your business's situation. But through this process of financial forecasting, we will kind of illuminate how you can come up with what your gross profit margin is. All right. So empower yourself and don't overthink it, I think, are two very important perspectives to have when you're approaching financial projections. So just keep in mind that it's never going to be 100% accurate, but the goal is to be directionally accurate. Profitable, not profitable, right? Like directionally accurate. And then if you're, as you are predicting, your profitability, you want to be able to explain the assumptions behind that profitability that you're predicting. So, and these assumptions should be informed by primary and secondary research. And I will say, like, you can always go online, you can find industry standards. There are plenty of articles written about all of these financial concepts, and even, subdivided into different industries for these financial concepts. But your own data is going to be the best data. So that's why it's so important to track a lot of information about your business. And we'll get into like what things are important to track and how you can track that a little bit in this presentation. So when we're talking about assumptions, I just want to make this a little bit more tangible. So explaining your assumptions, here are some examples. A question someone might ask you is like, how will you double your subscription revenue in year 2? And an assumption that you can answer with is, we will hire 2 sales reps, generating 200 leads per month and converting 5%, right? That's some hard math, right? Like that we're making some assumptions around, like we're making some assumptions that a sales rep can handle, I guess, 1 sales rep, 100 leads per month, right? And that conversion rate of 5% is an assumption. But maybe we've talked to our sales rep, maybe they've told us that that's how many leads that they can handle a month. Maybe we've talked to a mentor who has given us this advice, if we're just starting out. And this is the assumption we're working with. And that's, that's the best thing we have at the moment. Maybe in the future, we'll be able to draw from our own data and create an even stronger assumption. So another example of a question you might get, why does your gross profit margin increase by 12% in year 3? Well, we're going to raise our prices and cut hosting costs per user with volume discounts by that time. You should not overthink these questions. There are kind of simple answers to these questions that people might ask about your financial projections. So we're going to talk about how to build up these assumptions using these financial concepts that we're going to cover today. One last note here, and this is especially relevant, because of the pandemic that we find ourselves in. Sometimes it's best to create multiple versions of financial forecasts if there is a really great uncertainty around, a major event that's going to affect your finances. So, right, like if a vaccine comes out and it's very available within 3 months, that may have a huge impact on your business, rather than an alternative scenario where it's 6 to 9 months until things are kind of back to normal. So you could create sort of more aggressive or positive versions of your financial projections, or you can create more conservative ones, depending on how you feel about certain factors like the pandemic. Okay, so now that we've covered a little bit about kind of some perspective around financial projections, and that's trying to empower yourself to answer these tough questions and then being ready to explain your assumptions, right? Now we're going to get into the actual meat of financial projections. So first and foremost, revenue. Very simply, revenue is price times what you're selling. We can call it units. You can call it something else, but that's your basic revenue formula. But it gets more complicated after that. So we have price. How do we determine our price? Maybe you have a business and you've already set your prices, but if you haven't, or even if you have already, it may be a good idea to listen to these different pricing strategies that I'll go through in the next slide. All right, so here are 3 different pricing strategies that you can use to set your prices. The most common one, I think, is the first on the left here, cost plus. So very simply, we take the costs associated with creating our product, and then we just add a certain amount on top of that, right? Like if we find our cost to be $10, and then we say I want to make like a 20%. I want to mark that up by 20%, and then we're going to make that 20% on top of that $10. Right. So very easy, very simple. However, this method of pricing your products, it completely ignores the customers. So we're not talking to our customers. We're not even talking to our competitors or doing any research if we are just using cost plus. So cost plus can be useful for finding maybe that price below which we shouldn't go. But there's a whole range of prices above that floor, that price floor that we have no idea about. We're given no insight to that, to all of those other options above, that floor. So it can be helpful to do use these other pricing strategies as well. But I do want to say one good example of cost plus pricing is a company called Everlane. And if you go to their website, you can actually see that their part of their brand is about price transparency. And they actually break it down for you visually, where they say, like, this is how much the product costs. This is what we're putting on top of it as our markup. And this is what other brands are putting on top of it as their markup. So they're kind of using that cost plus as like a basis for their brand, and then comparing it to other retailers, other clothing retailers. So that's an interesting example. that is mostly cost plus with a little bit of competition-based pricing as well. Secondly, we have our competition-based pricing, right? So maybe you do some research about your competitors. You find, everybody's pricing their product around $20. So you say, well, I'm going to price mine about $20. Or you could say, my competitors are $20, but I think my product is of a higher quality, so I will price it at $25 or $30. Or maybe I'll try to undercut my competition and price it a little bit lower than what they're doing. So again, this is very simple, right? Like you can just go online and find these prices. It sort of indirectly evolves with the market, right? Like as your competitors, right? Like if you're kind of keeping track of your competitors' pricing, this will, you will change along with them. But again, this ignores the customer, and it's relying on your competitors to have actually done the research needed to get to the right price point or the best price point, which they may not have done. And then third, your value-based pricing. This is based on your customer's willingness to pay. That's what WTP stands for. And so the pros finally is that it is actually customer focused, and it evolves if you keep doing it, if you keep iterating your value-based pricing strategy, it will evolve with the customer and their thinking about your product. But the major con here is that it takes a lot of time and effort to get good at value-based pricing. It's not just something you can Google so much. To basically take this a step further with value-based pricing, what you would need to do is actually survey, your potential or current customers and ask them about what they would pay for a certain product or service, right? And how you present yourself can have drastic can drastically change the answers of the people you're surveying, right? And so just an example of that. So the point here is that your value proposition or how you present yourself is really the key to your pricing. There's a really interesting company called Profitwell that advises companies on their pricing strategies. And what they do sometimes is they will survey thousands of current, former, prospective customers of, like in this example, project management software. And they will gauge these current, former, and prospective customers' willingness to pay for these different based on the different value propositions. So they presented them with keep everyone on the same page, have a central source of truth, reduce check-ins and meetings, right? They presented these people with these value propositions, and they found that people were willing to pay different prices based on the different value propositions. So I just want to kind of take it back to that very basic the business principle of like your value proposition or kind of your 30-second elevator pitch sort of, and say that it really is the key to sort of unlocking these different price points with your customers. I have whole other presentations on pricing I could go on, but I'll try to stop myself because I know we have a lot of other material to cover on financial forecasting. So, okay, so now that we've talked about how your price should be hopefully based on your customer's willingness to pay, we then have to fill in the third part of this equation, the units. How many units are we selling? And the concept that we're going to use to determine this is a sales funnel. So a sales funnel is this kind of visual concept that you have all of these leads kind of percolating up top, and then you have to sort of make them aware of you. You have to interest them, maybe educate them, engage with them somehow, maybe make them sign up for a trial, And then finally, after you've done all of these steps in the sales funnel, you'll have brought them down to actually purchasing your product or service. So we're not sort of pulling numbers out of the air. We are basing our number of sales on our marketing tactics. So, and here are some kind of marketing tactics on the left, right? Like you could create awareness by participating at a convention. You could create interest by creating digital content. You could do sales calls, you could have sales visits. Right, so these are the different tactics to bring people down the steps of your sales funnel to that to ultimately purchase from you. Maybe you're familiar with this kind of concept, graphically like this, visually, but I want to transform this into numbers for you to make it a little bit more real and practical for when we're talking about financial projections. So here's an example sales funnel for telesales. So running along the top here, we have the months, and we have the number of callers that we are employing. Maybe these are sales reps that we've hired. And one of the assumptions that we're making here is that one caller can make about 600 calls per month. And then 5% of those calls will become prospects. And then 30% of those prospects will become opportunities. And 50% of those opportunities will ultimately convert into sales. And so going along with this, we can even calculate the cost that it takes to acquire one customer. So if we have one caller in January, who we are paying like $2,600, maybe we're paying them like $2,600 a month, and we have 5 sales converted from that caller. That means our customer acquisition cost, or CAC, is $520. We're taking that $2,600 and dividing it by 5 to get $520. So not only do we have our number of sales, but we've also given ourselves a way to compare different sales tactics. If our telesales, gives us a customer acquisition cost of $520, then I can take that and measure that against other sales funnels that I might have built for myself, right? But ultimately, what we're getting here is this number of sales converted, right? Like our input is callers and our output is number of sales. Another example here, because not everyone, right, like has a sales team or needs a sales team, right? So another example is maybe I'm going to create blog content. And I'm committing, this kind of goes back to this is my monthly kind of to-do list. I'm committing to publishing 4 blog posts per month. And my assumption here, maybe it's based on previous blog posts that I've made, is that I am going to have about 100 views per piece of content. And so very simple math here gives us about 400 leads per month with these assumptions. Maybe I'm also going to do some paid online advertising that's sort of based on cost per click. So I have my monthly ad budget. I'm dividing that by my average cost per click, and I'm getting a certain number of leads. So now that I have my leads from my content marketing and my cost per click marketing, I'm going to convert those into actual customers. So maybe I'm going to say that 5% of those leads from my content marketing are going to become, they're going to actually become trials. And 3% of those leads from paid online advertising are actually going to sign up for my trial. So that's going to give me 32 trials in my first month. The trial is a month long, let's say. So only some of them, only 33% are converting to customers in the next month. So this is just another example of a sales funnel. I didn't want to just give you telesales as an example, because not everyone is going to have a sales team. But the idea here is that when you're thinking about how many units am I going to sell, you're thinking about what marketing channels am I going to use and what are my inputs for those different marketing channels, and then how am I going to do some math to estimate my outputs, right? If it's content marketing, my input is my number of pieces of content that I'm publishing. I have to make an assumption about how many views I'm going to get, and then I have my leads, and then a certain percentage of those leads become people who are doing trials, and a certain percentage of those people doing trials become customers. So you can kind of see the sales funnel idea working here. We start with a lot of leads, we have a lot fewer trials, and then even fewer customers. So that's the sales funnel. All right, so now that we've filled in the whole picture here, we have our units is just our marketing times our conversion rates. We now are able to estimate our revenue. But for some businesses, you're not just selling one thing, right? So not only do we need to calculate our number of sales, we also need to calculate what they are actually buying. This is a company that I've worked with called Auden & Co. They are a kind of full service creative marketing agency. They do a lot of branding work, a lot of web design. They do some graphic design too. They have divided their services into 3 different packages. So on the left here under sales mix, you can see the 3 different packages. We've got our brand essence, radiance, and brilliance packages. I wanted to do a service-based company here because it's harder to sometimes divide your services, into different packages like this. It's a lot easier for a retail company if you're saying, well, I'm selling 100 shirts, I'm selling 200 hoodies, right? Like the categories sort of sort themselves out. But for a services company where there aren't clear-cut lines like that, you sometimes have to draw your own lines about, this is the package that I think I'm going to sell. So at the top here, we have our total number of sales coming out of our sales funnel, right? And then we're saying that 45% of our sales are coming from our brand essence package. And about 33% of our sales are coming from brand radiance and 22% from brand brilliance. And then we're just dividing that total number of sales into those different categories. And then of course, we just multiply those different packages that we're selling, that we're estimating that we're going to sell, by their different prices to get our revenue for each kind of package, and then add it all together, and that is our revenue. So we have calculated our revenue. All right. Cool. Any questions at this point? I just want to pause because I know that was a lot. So I just wanted to take a second. Now that we've kind of gotten through the first main financial concept, anyone lost at this point?
I'm not lost, but I would love to just ask a quick question if I can.
Yeah, please.
So I work for a consulting company and I'm on the sales side, but I'm really interested in helping it grow because we're still, a pretty young company. And so when we're looking at, forecasting our sales capacity, which I'm not sure if that's, sort of an offshoot of what you're describing, but we're having a little bit of trouble sort of, at least I am, figuring out how to understand, how to pick apart the various aspects of what we're doing. Are you going to get into any of that?
Yeah, that is a really good question. That is kind of the 200 or 300 level class. And this is okay. More like the 100 level, unfortunately, but I'm happy to share, some templates, if afterwards, if you kind of want, I'll list my email, at the end of this presentation, and I'm happy to kind of share some templates that I've used to deal with that capacity planning issue, I do usually find it, to be helpful when planning for like the number of sales reps that you want, the number of like account executives, or the number of like customer success reps that you want. And yeah, it's really, just to give you a short answer, it's really a matter of deciding what responsibilities you want a person to cover, and then how, choose your time frame, right? Like you could do it on a weekly basis, you could do it on a monthly basis. You just want to say, I want you to do these responsibilities, and I think it'll take this long to get these outcomes. So if that makes sense. And then you do a little bit of math there to estimate whether, right? Like you can see there are 152 working hours in November. And so, if you can say, am I close to that 152 hour number, or am I way over, or am I way under? And then you can get a sense of whether your responsibilities for this person are actually filling up a whole month. So that's the short answer.
That was great. Thank you. And I'd love to connect afterwards. Thank you very much.
Yeah, happy to help. Okay, great. So, so now that we've got revenue, let's talk about some other parts of your financial forecast, right? So now we have to get into your costs. And your costs are going to be divided into two different groups for the purposes of forecasting. And really for the purposes of managing your business generally, they should be divided into two different groups. So first we have direct costs, and as the name suggests, these are costs directly related to creating or acquiring, if you're kind of reselling the product or service. These are also, they can be called cost of goods sold. You may have heard COGS before, COGS. These are also usually variable costs. They change with the number of, basically your costs change as you sell more or fewer products, right? Which is, very logical. And then I've also heard this called cost of sales as well. So the two main categories of direct costs are direct labor and direct materials. And in our little coffee shop over here, we have, not just the beans that we're roasting, of course, to make the coffee, but also the cup, lid, cozy that we're putting the coffee in. And then we would probably also do, all of the kind of cream and sugar and other things that are being put into the coffee, whether by us or by our customers, if we have to pay for it. Additionally, some labor costs are direct costs. So you can't get this coffee without the barista. So we're going to need to include that labor in the costs. So those are all examples of direct costs. So once we have our revenue and our direct costs, we can subtract the direct costs from the revenue to get our gross profit. And then if we want to see what our gross profit margin is, we take our revenue minus our direct costs divided by our revenue. And so I like to think of gross profit margin as this is the amount of revenue that is making it past our direct costs. And so why do we care about gross profit or gross profit margin? So the answer is that if it doesn't work, right? Like if the business doesn't work at this point, then it's going to be very, very difficult for the business to work at all. Because we haven't talked about all of our other expenses yet. It kind of has to work on a unit by unit basis before, we actually say like, yes, this is a business we want to start, right? So if your business doesn't work on like, if I sell one of these, I'm making more than it costs me, then you have to decide whether you want this to be a business or maybe a hobby, right? And then gross profit margin, people get hung up on, what should my gross profit margin be? Like, what's a good gross profit margin? And like I said at the beginning, it really depends on your business and your industry. Basically, you can compare your gross profit margin to other businesses kind of regardless of size, right? Like if 50% of your revenue is making it past your direct costs, you can take that and to another business owner and say, how much of your revenue is making it past your direct costs? Or in other words, what is your gross profit margin? And if they say 50%, then you know that, maybe your prices are about the same. Maybe you're paying similarly for, in this coffee shop example, maybe you're paying similarly for the labor and the cups and the coffee. The prices can influence gross profit, and your direct costs can influence gross profit. Okay, so now that we've covered that, let's get into our other expenses. Those other expenses that I mentioned, which can also be called indirect costs. So that's kind of a nice way to think about it. You have your direct costs directly related to the product or service, and then you have your indirect costs that are necessary to have the business perhaps, but not necessarily to create the product or service. And here are just a bunch of examples, right? Insurance, rent. Most people have accounting fees. You're going to have some office supplies. A big one that you should definitely have is a marketing or advertising expense, legal fees, equipment, and maybe this is reminding some people of like an accounting system, right? Like these could be different accounts in an accounting system, and you could track your expenses in these different categories, right? Like you can go into QuickBooks and they probably already have an accounting account that you can track your accounting fees under. Same with marketing and advertising. But one kind of tip here is that instead of just having one marketing and advertising account, maybe try to split that into a few different accounts. Maybe you have your paid social media, maybe you have your graphic design work, which is different than your paid social media, or if you're paying for Google ads, or you can subdivide your different marketing fees and track them differently, and hopefully that'll give you insight into, okay, I spent a lot more on Google ads this month, and I saw a big spike in sales. So now I know that Google ads work, right? So you can sort of test out those different marketing spend categories if you can track them. All right, so now that we've covered operating expenses, let me see here. I'm going to show you kind of the whole picture. So this is an example, sort of like yoga studio that also does a little bit of retail. And this is at the very bottom, we have our operating income or loss. At the top, of course, we have revenue, right? We have our revenue from these private training sessions we're giving. We have revenue from our yoga classes. And then we also have, a little bit of retail revenue. Maybe we're selling some hoodies or something like that as well. And then our direct costs, we have to buy those hoodies that we are selling, and we have to pay our trainers to offer those private sessions or yoga classes. And then our revenue minus our direct costs gives us our gross profit. We have a very high gross profit margin, which honestly suggests to me that maybe the owner of this business isn't including their own salary into this equation, perhaps, or maybe they're putting all of their salary into their operating expenses. I don't know. So then once we have our gross profit, we're subtracting our operating expenses from that gross profit and getting our operating income or loss. So in month 2 and month 3, right, we have a loss, but in month 1 and month 2, we have a loss. And in month 3, kind of pulling back up here, this is not uncommon for businesses to have a loss, perhaps at the beginning of the year when they have to renew all of their licenses or, all of their registrations, or maybe they are planning on buying a new piece of equipment in January. And so they have a loss for that month as they make a big expenditure, but, they kind of pull it back up, over the course of other months. So this is one of the reasons why it's important to do a monthly forecast, because you can see these cash flow issues coming up, and you can say, well, maybe I do need that line of credit or something like that. Okay, great. So now that we've covered the financial concepts, we've put it all together in this way, I want to take you into an actual example financial model that I built out with a client in Excel. And you can see how all of this is actually like working together practically. Before I do that, I see that there's a question from Jim Ellis. So question for clarification around app development costs. For an app business, are these included before or after gross profit? So that is a really good question. The answer is there are 2 types of development costs. For everyone who is considering kind of software-based businesses or software as a service or SaaS-based businesses, there are 2 development costs. There are the initial development costs to build out the software or technology that you are wanting to basically sell to others, right? The platform that you're building or the app that you're building. So you need to pay a developer or hire a developer, a software engineer, and their salary perhaps, and any subscriptions or technology they need to actually create the product. That is an operating expense. So that goes after gross profit. Once you have the product or platform or service set up and built, there is ongoing maintenance and updates that you need to do to that software or platform to continue to make it work, right? You're going to find bugs. You're going to want to make little changes. That goes in direct costs. So that's also called DevOps. I like to think of it as ongoing maintenance and updates to your software. So that goes above gross profit in direct costs. So yes, hopefully that answers that question. And then, cool. So I'm going to stop sharing my screen here and pull up a different screen. Just a second. Okay. All right. Sorry, I'm not as familiar with Zoom. Okay. Can you all see a spreadsheet? Are you looking at a spreadsheet?
Yes.
Okay. Thanks, Doug. Great. So I'm just going to zoom in a little bit here. So what we have here is these sections of a financial forecast or financial model. Before we get into it, I just want to explain a little bit about the business so it makes sense. This is an eyeglasses retailer. So they have a storefront. They also have like a little mobile unit that they take on the road, and they can actually sell out of that, which is kind of cool. So, fairly simple, fairly small business that we're going to be demoing today. Up here at the top, I've set it up so that we're starting in January 2021. These models should be able to change dates pretty easily. you should be able to sort of just plug in like, oh, well, it's January now. I want to start this in February. And then, the date should be able to update correctly. So getting into the sections here a little bit. So the first section is kind of customer acquisition. This could also be called like lead generation. It could be called, any number of different things. I would just encourage you at the top here, if you have a financial model that you're building out yourself, or if you are using a template, it is really, I think, helpful. I found, as I work with clients, to customize these for what you want and what makes sense to you. I think a mistake that you could make here is saying that like, I have to, name everything the technical accounting, business jargony term. These models are too complicated for you to get lost in the terminology. So I would just empower and encourage you to change the colors to things that you actually want to look at, right? Change the terminology to what makes sense for you and what clicks the easiest. But in this example, we have our customer acquisition section, which is where we have our marketing channels that are generating our leads or maybe visitors to our shop, whatever they're kind of leading towards. And then we have a section where we take those leads and we convert them into sales. And then we take those sales and basically divide it into like what we're selling, add that up, we get our revenue. And then, of course, we have our cost of goods sold, right? Like if we're an eyeglasses retailer, we might have to buy those frames for the glasses that we're selling. So that's where we put that. And then we have all of our other expenses, our rent, insurance, utilities, that sort of stuff. And so we'll go into each of these sections a little bit, and then we'll go to this summary tab down here, and it'll tie everything together. So when I open this up, there's going to be a lot here. So you can see that this entrepreneur wanted to do she wanted to list out all of these different marketing channels, right? So we're estimating foot traffic. We have organic social media, which is coming from like the number of posts that we're doing, the views per post, maybe the number of visitors to our store from that. Paid social media, we have events, we have mobile events, we have partnerships. So it can be tempting to list out all of your marketing channels like this, but models quickly become too complicated and overly large. So I'd actually encourage you to maybe stick with fewer kind of marketing channels here, because if you list out too much, it's going to be just more work to go back and update it when you have those actual numbers. And sometimes you can't track it. Like, do you really want to track your foot traffic? Maybe, maybe not. So basically what you can say is, if you don't want to sort of like mathematically link all of this and track all of it, what you can do is you can say, I think you can sort of say that like, these are my marketing channels, and I'm not going to mathematically tie it to my number of, leads or visitors in this case, but I'm just going to say from my marketing efforts, I think I'm going to have about 80 visitors. So basically what I'm saying is like, you have these two options. You can list out all of your different marketing channels that you want to track and set goals against, or you can sort of list them out, but not mathematically link them like they are now. This is kind of just like, the most sort of accurate way that we can do it. One marketing channel I want to point out here is word of mouth referrals. So maybe you're saying that I think a certain percentage of my customers from the past 6 or 12 or 2 or 3 months are going to refer other customers to me. So I just want to use that as an example here to say like, that's a common one for businesses if you're thinking about different marketing channels. So all of these marketing channels are leading towards a number of visitors to our shop. Okay, so I'm going to close this up and I'm going to open our sale conversions. So this is actually not a funnel. So our funnel is in the customer acquisition section, and it's a very wide funnel with not many steps, right? Basically, we're just making the customers aware and interested enough to get into the store and maybe make a purchase, right? There are only a few steps in this sales funnel. And so once they're in the store, we're saying that 20% of the foot traffic, 10% of the people who come from organic social media, maybe 15% of the people at our mobile events are actually going to make a purchase. And then here are our total new sales per month. And so what we're saying here is, if you're going into this level of detail, you're saying, well, I'm going to ask people, how did you hear about us? Was it paid social media? Was it organic social media? Were you just walking by? And I'm going to track against that. So then once February comes around, I'm going to put in, well, actually, it was 10 people who just walked up. And so you can override the formulas here, right? Like I'm doing math based on this number of sales times this percentage. But once you have that number, you should update your forecast. You should just go in there and update it. So that hopefully in the future, you can become more and more accurate. You can learn from your own data. Okay, so now that we have our total number of sales, we're going to ask ourselves, okay, what are they actually buying? So here are my products, and here's the sales mix. So 40% of my customers are buying bifocals. And so from my total sales up in my sales conversion section, times 40%, I'm getting 17 bifocal sales projected in February 2021. And then, of course, we just multiply that by our average price. Over here, I've given myself the option, right? And this is the advantage of working in Excel instead of maybe something like LivePlan or something that's more rigid. In Excel, if you can link up the formulas, you can give yourself the option of changing your prices in your forecast. So basically what I've done here is I've allowed myself to change my prices and up my revenue in 2022. I've hidden that here so you're not overwhelmed by numbers, but that's the idea. You could change your prices. So now that we have our revenue here, we're going to go into our cost of goods sold section. So that's 17 sales. We're going to multiply that by $20 to get $340 as our cost of goods sold for selling those bifocals. But it's not, in this case, it's not actually just the frames that's costing me money. There are lab fees associated with it too. And so I would also include those in the cost of goods sold, also known as direct costs of this business. Okay, so now that I have my cost of goods sold, I want to make sure that I put in all of my other operating expenses. So I have my marketing spend up here. Maybe I have an intern who's doing 40 hours a month, $10 an hour, and they're starting in October and ending in July. And so, that's going to calculate over here. I'm doing some paid social media. Maybe I still need to write in when I'm going to have those business cards printed. I have a van and I have, my gas and maintenance. I don't know when I'm going to have to spend for maintenance on my van, but maybe I'll average it out to about $20 a month or something like that. And then facilities, pretty simple, right? I just input a monthly cost for rent and supplies. Maybe I have a QuickBooks subscription. Maybe what I'm missing here is some more accounting or legal fees. Maybe those should be in there. So then I'm going to close this up, right? And then I'm going to go over to the summary tab. And this is going to look pretty similar to what we were looking at the end of the PowerPoint presentation, which is, here's my revenue for these 2 years. There's my cost of goods sold. Here's my gross profit. And then operating expenses, and then of course, operating income. And then my operating margin is down here. So this is, kind of in the same vein as gross profit margin, but the question is how much of my revenue is making it down to my operating income past all of my operating expenses and cost of goods sold. What I want to do here real quick in just the last few minutes that we have is just say that like something that stands out here as possibly wrong is this cost of goods sold number. So it's the same in both years, but my revenue is going up. So that's a red flag. So this is kind of a common pitfall for people creating financial projections. Maybe you've just copied your formulas all the way over through both years, but you've actually increased your revenue. It's very unrealistic. So I would go back and examine the numbers for your cost of goods sold. All right, so I am going to switch back, if I can, to the PowerPoint. Let's see if this works. All right, so, and I just want to take us to the final slide here. So some action items, if you're still trying to figure out your pricing, definitely have that value proposition developed, present it to customers and survey them to see what their willingness to pay is, and then do some analysis on the responses. If you need help with that, process, I'm happy to help. Feel free to reach out to me. And then if you are ready to work on your financial forecast, create those sales funnels, list out all of your direct costs so that if you're projecting that you're going to sell 1 unit, all of your costs related to that 1 unit, and then, be sure to list out all of your indirect costs and create that monthly forecast with these pieces. And then here's just some resources for you. So the Entrepreneur Roadmap is a sort of guide that JumpStart, that the business advisors at JumpStart have created to help you find your way on this sort of crazy entrepreneurial journey if you're embarking on it. I see that you still see the, how's that? Can you see this? Okay, sorry about that. It's not used to Zoom, but thanks, Andrea, for the comment. So yes. On the left, you see some action items, and then on the right, of course, the resources I was talking about, the Entrepreneur Roadmap, a guide for kind of finding yourself on this journey, one-on-one business advising. So people like me who work at JumpStart, I think I saw maybe another business advisor in the chat from Bob Sopko. Also, there are organizations around Northeast Ohio, like JumpStart, that offer free one-on-one advising, right? Like we receive money from the state of Ohio, from Key Bank Foundation, the city of Cleveland, to drive economic development. And what that means in practice is helping people, create financial forecasts, for example, and set realistic financial goals and do some of that really necessary planning work that can help you take your business kind of from not knowing exactly what's going on to really having set, intentional goals and sort of monthly actions that you need to do. If you're looking for more instruction on financial projections, I recorded a video over a PowerPoint slide, over a PowerPoint deck. And it's called Financial Projections for Subscription-Based Businesses, Common Pitfalls and Best Practices. And then I also wrote a blog post recently called 4 Steps to Developing Your Financial Model, So hopefully we'll send this slide deck around. You can click on these links and access these different resources. Another great resource for pricing is that Price Intelligently is kind of the same company as Profitwell, which I mentioned earlier about pricing. So with that, I am all done. Happy to answer kind of any other questions that you might have at this point. Oh, and yeah, I can definitely share the Excel template. Happy to share that. And yeah, I'll just say again, most entrepreneurs don't get into their business wanting to play around in an Excel sheet for hours and having to learn all those formulas. So I'm more than happy to sort of help you with all of that sort of Excel and Google Sheet work if Google Sheets is your preference, or Excel or anything like that. So feel free to reach out.
All right. Well, thank you so much, Phelan, for taking the time today. Went a couple minutes over, but if you have any questions, please reach out to Phelan or myself.